Imagine you're sitting in the testing center, right? You have just perfectly computed this massively complex corporate tax liability.
Oh, that is the best feeling.
It is. You navigated the allowable deductions, you nailed the fringe benefit taxes, you feel completely unstoppable, but then you click to the next multiple choice question.
Let me guess, it's a procedural question.
Exactly. It simply asks, what is the maximum number of pages allowed for an income tax return? Or, maybe it asks for the exact deadline to file a return after a corporation adopts a resolution to dissolve.
And right there, your momentum just stops. I mean, you
You
freeze.
completely freeze. Well, welcome to this deep dive on ICPA Review Radio. You are in the home stretch of your preparation, and today we are targeting a very specific area of the taxation board exam that examiners use to filter out candidates who only focus on the math.
Yeah, that happens a lot.
Right. We are tackling sections 51 through 59 of the National Internal Revenue Code, so that covers returns, payment, and withholding. Our mission today is to decode not just what these rules are, but, why they exist. Because understanding the logic is how you actually retain this stuff for exam day.
That is honestly the perfect mindset to have. When you study tax law, the computations naturally pull your focus.
Yeah.
But the government cares just as much about the procedural mechanics, like how and when they actually collect the cash.
Because what good is a tax if you can't collect it, right?
Exactly. They care about that just as much as they do about the final tax due.
Yeah.
If you master these administrative thresholds, the strict deadlines, and the specific exceptions, you're securing points that so many candidates just leave on the table.
Yeah, it's basically free points if you know the rules.
Totally. I mean, at its core, tax law is fundamentally about the government managing its risk and ensuring its own cash flow.
Right, so to understand that risk management, let's look at the baseline. The entire compliance system is built outward from the most common taxpayer you're going to encounter, which is the individual. Section 51 lays out exactly who must file an income tax return.
Right, and the general rule for individuals gives us 4 mandatory filers that you absolutely have to commit to memory.
Okay, let's hear them.
First, resident citizens who are taxable on their global income, meaning, everything derived from both within and outside the Philippines.
Makes sense.
Second, we have non-resident citizens. Third, resident aliens. And fourth, non-resident aliens engaged in trade or business.
Okay, and for those last 3, it's different, right?
Yeah, those last 3 classifications are only taxable on income derived from sources within the Philippines.
Okay, so that establishes the core net the government casts. But on the CPA board exam, your radar should immediately go up when we start talking about who is explicitly exempt from that filing requirement. Examiners, they just love testing the exceptions.
Oh, they really do. It's prime multiple choice material.
Definitely. So to help you lock this down, we use the FMPS mnemonic for the 4 primary non-filers.
Let's break those down sequentially because the logic behind each exemption is actually slightly different.
Sounds good. So starting with F, which stands for final tax only. If your sole income for the year has already been subjected to a final withholding tax, you just don't need to file an annual return.
Right, the classic example there is interest income from a bank deposit.
Yeah.
And the reasoning there is pure administrative efficiency. The bank already withheld the final tax, they remitted it to the BIR. So the government has its money, the liability is completely extinguished. Requiring you to file a piece of paper just to report it would, frankly, just clog up the system.
Right, totally unnecessary paperwork. Okay, moving to M, which stands for minimum wage earner. This one is basically a statutory exemption designed to protect the most vulnerable segment of the labor force from, administrative burdens.
Exactly.
Then we have P, which is a massive focal point since the train law amendments. This exempts individuals whose taxable income does not exceed 250,000 pesos.
We will definitely need to circle back and look really closely at that 250,000 threshold.
Oh yeah, it's a trap.
A huge trap. It contains one of the most dangerous trick questions on the exam. But let's finish the FMPS list first.
Right. So the final letter S stands for substituted filing. Now, Section 51A is heavily tested. For a taxpayer to qualify for substituted filing, they have to receive pure compensation income from only one employer in the Philippines for the entire calendar year.
But there is a second equally important condition there.
Right, the income tax must have been withheld correctly by that employer. So the tax due has to exactly equal the tax withheld.
Think about the mechanics of why substituted filing works. The employer is essentially acting as the government's calculator and collector. If you only have one employer, the math is static.
It's predictable.
Exactly. The employer deducts the tax, remits it, and issues you a certificate of withholding. That certificate effectively becomes your tax return. The government already possesses all the information they need regarding your income.
But the moment you introduce a second employer concurrently, the math breaks down
It completely shatters.
because neither employer knows what the other is paying you.
Yeah.
Right? So they can't accurately calculate your graduated tax rate. So even if your combined income from two simultaneous jobs is, say, only 200,000 pesos, which is well below the 250,000 threshold, you are still required to file an actual return to consolidate that income and prove it.
Yeah, that is a brilliant distractor in multiple choice questions. They love throwing that scenario at you.
They really do. And, while we're discussing the physical return itself, it's worth noting a very specific mandate introduced by the Train Law to promote the ease of doing business.
The page limit.
Yes.
Okay.
Whether you are a resident citizen or an alien, the individual income tax return is strictly capped at a maximum of 4 pages, whether that's submitted in paper or electronic form.
Just 4 pages. Profile, gross sales or receipts, allowable deductions, taxable income, and tax due. It just strips away all the clutter.
Exactly. I mean, it seems like a minor administrative detail, but it is highly testable because it represents a pretty major legislative shift in how the government interacts with taxpayers.
For sure.
Let's touch on a couple of filing quirks before we move on. For married individuals who don't derive income purely from compensation, the default rule is to file one consolidated return that includes the income of both spouses, right?
Right. Now, if it's genuinely impracticable to file together, they can file separately. But the BIR will still consolidate them for verification later anyway.
So they can't game the system.
Exactly. That prevents spouses from artificially splitting their income to stay in lower tax brackets.
That makes sense. And here's an interesting intersection of tax concepts. What happens to the income of an unmarried minor if that income is derived from property they receive from a living parent? Generally, that income has to be included in the parent's return.
Unless a specific condition is met, which really tests your ability to connect income tax principles with transfer tax principles.
Oh, this is a good one.
Yeah, so the minor's income is included in the parent's return, unless the donor's tax was already paid on that property transfer, or, and this is key, the transfer was legally exempt from donor's tax.
So the government is essentially saying you can't just park income-generating assets under your child's name to avoid income tax.
Right, unless you've properly cleared the transfer tax hurdle first.
It's all about closing loopholes. Okay, let's pivot back to that P in our FMPS mnemonic, the 250,000 peso threshold. I want to look at this from the perspective of a reviewee who's trying to apply the rule logically during the exam.
Okay, so then.
Let's say I operate a very small online business, like I'm selling custom artwork, I calculate my taxable income for the year, taking my gross receipts minus my allowable deductions, and I only made 180,000 pesos.
Okay.
Since that is clearly below the 250,000 threshold, my instinct is that I'm totally exempt from filing an ITR.
And that instinct is exactly what the examiners are preying on. You would have just cost yourself a point.
Wait, really? But the Train Law explicitly says individuals under 250,000 are exempt. I mean, if I owe absolutely zero tax, what purpose does filing a return even serve? It just feels like unnecessary paperwork for both me and the BIR. What is the government's angle here?
Well, the angle is visibility. It's the audit trail. You have to look really closely at the proviso in Section 51A2A. It explicitly states that any individual engaged in business or the practice of a profession must file a return, regardless of the amount of gross income.
Regardless of the amount. Wait, so even if my business operates at a net loss for the year?
Even if you operate at a massive loss. See, the government distinguishes heavily between a passive employee and an active business owner. An employee's income is reported by their employer, but a business owner is self-reporting.
Oh, I see.
Right, so if the law allowed small business owners to simply self-determine that they made less than 250,000 and therefore didn't need to file, the BIR would be entirely blind.
They'd have no record of you at all.
Exactly. They would have no commercial baseline, no record of your gross sales, and basically no way to ever audit whether your claim of making only 180,000 was actually true.
Okay, that clicks. So filing the return establishes the legal record under penalty of perjury, even if the bottom line says zero tax due. So if you see an exam question asking if a self-employed graphic designer with only 240,000 in gross receipts needs to file, the answer is an absolute yes. The nature of the income overrides the numerical threshold.
Precisely. And that concept of the government meeting visibility, It perfectly transitions us into how the rules escalate when a business grows and decides to incorporate. Because under Section 52, the compliance burden shifts dramatically.
Yeah, scaling up the business means scaling up the risk for the government. Corporations are playing with much larger numbers, so the government just isn't willing to wait around for a single annual return.
Exactly. Corporations are required to render true and accurate quarterly income tax returns, and then that's followed by a final or adjustment return at the end of the year.
So they want their money faster.
Yep. The government wants its cash flow spread throughout the year, rather than waiting 12 months and just hoping the corporation still has the funds to pay. Though, keeping with the ease of doing business, the corporate ITR is also capped at a maximum of 4 pages.
Good to know. There's also a structural difference in how they measure their year, right? Like, individuals are strictly bound to a calendar year, January 1 to December 31, but corporations have a bit more flexibility.
They do. Corporations can employ either a calendar year or a fiscal year. And a fiscal year is just any 12-month period ending on the last day of any month other than December.
Right.
But the highly testable element here is the restriction on changing it. A corporation cannot change its accounting period without prior approval from the commissioner.
They lock you in.
They have to. If a corporation could freely switch from a calendar year to a fiscal year whenever they wanted, they could strategically manipulate their reporting periods.
To defer taxes.
Exactly. To defer massive tax liabilities or push income into different periods indefinitely, the BIR needs predictability.
That makes total sense. Now, let's explore a very specific, heavily tested scenario regarding corporate dissolution. When I teach this, I try to get reviewees to visualize a corporation, not as a piece of paper, but like as a tenant renting an apartment.
Ooh, I like that.
Yeah, if you're a tenant and you want to move out, you can't just pack your boxes and vanish in the middle of the night. You are legally required to give your landlord 30 days notice. And crucially, you don't get your security deposit back until the landlord does a final walkthrough of the empty apartment and officially signs off that you didn't damage the property.
That analogy perfectly illustrates the mechanics of Section 52C.
Right.
When a corporation contemplates dissolution or reorganization, the government acting as the landlord needs immediate notice because the entity they have the power to tax is about to cease existing. So the law starts a very fast clock.
How fast?
Within 30 days after adopting a resolution or plan for dissolution, the corporation must file a correct return with the commissioner, detailing the terms of the resolution.
Okay, so the 30-day notice is the first step, and what about the final walkthrough?
The final walkthrough is the tax clearance. A dissolving corporation must secure a certificate of tax clearance from the BIR. The Securities and Exchange Commission will absolutely not issue a certificate of dissolution without it.
So they hold the paperwork hostage?
Basically, yeah. The government is essentially locking the door. You cannot legally dissolve and distribute your remaining assets to shareholders until the BIR has verified that every single outstanding tax liability has been paid.
It is the ultimate exit interview. The entity literally cannot die until its debts to the state are settled. That 30-day urgency is fascinating, though. It's all about the government acting fast before something disappears. Does the government use that same 30-day window when highly liquid or like hard-to-trace assets change hands, like certain capital gains?
They absolutely do, and it is a favorite topic for examiners. We need to look at Section 52D for corporations, which also mirrors the rules for individuals under Section 51. The specific asset in question here is shares of stock not traded through a local stock exchange, what we call unlisted shares. If you sell unlisted shares, you are required to file a return within 30 days after each transaction.
Why unlisted shares specifically, though? I mean, why not real estate or publicly traded stock?
Well, because publicly traded stocks are tracked instantly by the exchange, and real estate is anchored to the ground. It can't move. But unlisted shares are just paper representing ownership in a private company. They're intangible.
So they're easy to hide.
Exactly. They can be sold, transferred, or moved across borders very quietly. So the government imposes a strict 30-day transactional filing deadline, because if they wait until the end of the year, the trail of that private transaction might be completely cold.
But the compliance doesn't end with that 30-day transactional return, does it?
No, it doesn't. And this is the dual requirement you must watch out for on the exam. In addition to the 30-day transactional return, the taxpayer must also file a final consolidated return for the year.
Okay, and when is that due?
For individuals, that consolidated return is due on or before April 15th of the following year. For corporations, it is due on or before the 15th day of the fourth month following the close of their taxable year.
Got it. So if a multiple choice question asks which transaction requires both a transactional return within 30 days and an annual consolidated return, your immediate target is the sale of unlisted shares of stock.
Exactly right.
Cool. So we've covered the filing of the paperwork and the logic of the timelines, but filing is just the preamble, right? The true purpose of the tax code is the collection of cash. Under Section 56, the general rule is simple. Pay as you file. When you submit the return, you pay the total amount of the tax imposed. However, the law provides a specific relief mechanism called the installment option.
Yeah, and the installment option is highly testable because it has very strict boundaries.
Mhm.
First, this option is entirely unavailable to corporations. It's reserved for individual taxpayers only.
Good to note.
Second, the tax due must be in excess of 2,000 pesos. If those two conditions are met, the individual can elect to pay the tax in 2 equal installments.
Let's walk through the timeline of that. So for a calendar year individual, the first installment is paid at the time the return is filed, so on or before April 15th. The second installment is due on or before October 15, following the close of the calendar year.
Right.
It gives the taxpayer a 6-month breathing room. But there is a massive trap here. What happens if our taxpayer pays the first half on April 15th, but then completely forgets the second half, or, I don't know, pays it a week late on October 22?
Oh, the consequence is severe.
Really?
Yeah, the law states that if any installment is not paid on or before the date fixed for its payment, the whole amount of the tax unpaid becomes due and payable immediately, together with delinquency penalties.
Let's unpack the mechanics of that. If I owed 10,000 pesos total, and I paid 5,000 in April but missed the October 15 deadline, the government doesn't just assess a late penalty on the remaining 5,000.
Correct. You lose the benefit of the installment deferment entirely. By missing the deadline, you've breached the condition of the grace period. So the remaining balance accelerates, and the penalties are computed as if the entire remaining amount was due back on the original April 15 deadline. You broke the contract of trust, so the government retracts the leniency.
That is brutal, but it makes sense. That concept of liability and trust brings up Section 59. It establishes that the liability to pay the tax is determined as of the year for which a return is required. Essentially, whoever has custody, control, or disposal of the income is the one on the hook.
Exactly.
But staying on the topic of payment and cash flow, let's pivot to real property capital gains. Because Section 56 outlines a very unique refund mechanism that reviewees frequently confuse with filing deadlines.
You're referring to the capital gains tax exemption on the sale of a principal residence.
Right. Let's build a scenario for this one. Say I sell my principal residence. I know there's a special provision that exempts me from the 6% capital gains tax if I use the proceeds to buy or construct a new principal residence within 18 months.
Right, standard exemption.
However, at the exact moment of the sale, I haven't finalized the paperwork to prove to the BIR that I intend to use the money for a new house. But the buyer needs the title transferred. So to get the clearance, I go ahead and pay the capital gains tax. The cash leaves my hands. Later, I get my documents in order. Is my money just gone?
Not at all. The tax code is rigid, but it provides a specific avenue for relief if you follow the procedural steps. Section 56A3 states that if the seller pays the tax, but later submits proof of their intent to avail of the exemption, they're entitled to a refund.
Okay, that's a relief.
But, and this is a critical exam detail, the taxpayer must submit that proof of intent within 6 months.
But 6 months from when? This is where candidates stumble. Is it 6 months from the date of the sale?
No, it is exactly 6 months from the registration of the document transferring the real property.
Registration. Why does the law base the timeline on the registration rather than the actual sale date?
Well, think about it. A deed of sale is just a private contract between two people. It could sit in a desk drawer for 2 years. The government has no way of tracking that. But the moment you take that deed to the Register of Deeds to officially transfer the title, it becomes a public record.
So it's on the radar.
Exactly. That registration is the exact moment the government can officially track the transaction. That is the trigger for your 6-month refund window.
And as a safeguard, the Register of Deeds is legally prohibited from transferring that title without a certificate authorizing registration, the KRR from the BIR, proving that the taxes were paid or explicitly exempted. It is basically the ultimate choke point for real estate in the Philippines.
Exactly. Examiners love testing that 6-month refund window because they know candidates will confuse it with the 30-day filing deadline for the capital gains return itself.
So 30 days to file.
You file the return within 30 days of the disposition. But for the refund, you have 6 months from registration.
Got it. Okay, so far, we've talked about taxpayers filing and paying their own taxes. But what happens when the government looks at the economy and realizes they simply cannot trust millions of individual taxpayers to save up and pay their taxes honestly at the end of the year?
They escalate their collection tactics.
Right. They force the person paying the income to hold the tax back before the payee even sees a single peso. This brings us to sections 57 and 58, the withholding tax system.
The withholding tax system is really the backbone of government revenue. It operates on a very simple premise. The absolute most efficient time to collect a tax is at the exact moment the cash changes hands.
Because it's liquid.
Right. By deputizing the payer as a withholding agent, the government collects the tax at the source. Now, on the exam, you must clearly distinguish between the two primary types: final withholding tax and creditable withholding tax.
Final withholding tax is straightforward, right? The tax withheld is the full and final payment of the income tax due on that specific transaction. The pay is just done. They don't even report that income on their annual ITR. But creditable withholding tax is much more dynamic. The Train Law amended the rules, giving the Secretary of Finance the power to require withholding of a tax from 1% up to a maximum of 15% on various income payments.
The defining characteristic of creditable withholding tax is right in the name. It is creditable. It's merely an advance payment. The payee is still required to file their annual income tax return, declare that income, compute their total tax liability for the year, and then subtract the creditable taxes that were already withheld by their clients or employers.
Let's look at the legal nature of this withheld money, though. Often people think of withholding like an employer just hanging on to the government's lunch money for a few weeks, but that severely understates the legal reality. Section 58A establishes what is known as the trust fund doctrine.
The trust fund doctrine is a profound legal concept. It basically dictates that taxes deducted and withheld by the withholding agent shall be held as a special fund in trust for the government.
I want to translate that into a real-world business scenario just to show how dangerous this is. Imagine I run a corporation. I pay a supplier 100,000 pesos, and the law requires me to withhold 10%. So I'd only give the supplier 90,000, and I keep 10,000 in my corporate bank account.
Okay, tracking.
Now it's the end of the month, cash flow is incredibly tight, and my electricity is about to be cut off. Can I use that 10,000 to pay my electric bill, fully intending to replace the cash next week when a client pays me, before I have to remit to the BAR?
Absolutely not. And doing so is a criminal act.
Wow, really?
Yes. Think of withholding tax not as holding money, but as placing it in a legal quarantine. The very microsecond that 10% is deducted from your supplier's invoice, an invisible, impenetrable fence goes up around it.
So it's not my money anymore.
That money legally ceases to be yours. It is government property. Section 58D explicitly states these funds must be maintained in a separate account and cannot be commingled with the agent's operating funds.
So even if I put it back...
If a CEO uses that money to pay the light bill, even with every intention of putting it back, they aren't just mismanaging their cash flow. In the eyes of the law, they are embezzling from the Philippine government.
That is a staggering level of fiduciary responsibility. And because it is an advance payment, the withholding agent has strict deadlines to furnish the payee with a physical certificate, like the BIR Form 2307 for creditable taxes, right?
Yes.
For a corporate payee, the certificate must be provided by the 20th day following the close of the quarter. For an individual, not later than March 1st of the following year.
And the payee desperately needs those certificates.
Yeah.
Without them, they cannot prove to the BIR that the advance payment was made, and they won't be able to claim the credit on their annual return.
Which brings up the final mechanism of creditable withholding, the reconciliation. Let's say I'm an independent contractor. Throughout the year, my clients dutifully withhold 10% from all my professional fees. But at the end of the year, I calculate my actual income tax due, factoring in all my allowable business expenses. It turns out my actual tax liability is significantly lower than the total amount my clients withheld and remitted. What happens to that excess cash?
This is where the balancing act occurs. Under Section 58D, you report the total income, compute the actual tax, and apply the credits. If the amount withheld exceeds your actual tax due, that excess shall be refunded to you, or you can carry it over to the next year.
Oh, nice.
Conversely, if the withholding wasn't enough to cover your actual liability, you simply pay the difference. The creditable tax never extinguishes the liability until that final reconciliation is completed.
We have unpacked a tremendous amount of highly testable tax logic today. To ensure you walk into the testing center completely prepared, let's distill this into a 4-point exam day checklist.
That's good.
Number 1, the 250K trap. Yes, individuals earning 250,000 pesos or less are generally exempt from filing, unless they are engaged in business or the practice of a profession. If you are in business, the government needs that audit trail. You file, regardless of gross income, even if you are operating at a net loss.
Number 2, the 306 rule. Do not mix up these timelines. The government acts fast on high-risk events. You have 30 days to file a return when a corporation adopts a resolution for dissolution and 30 days to file a transactional return for capital gains on unlisted shares. But if you're claiming a refund for capital gains tax on a principal residence, your window is exactly 6 months from the registration of the document.
Great distinction. Number 3, the October 15th installment default. Individuals owing more than 2,000 pesos can split their tax payment. But if you miss that second deadline on October 15, you breach the contract of trust. The deferment is revoked, and the entire unpaid amount accelerates and becomes immediately due with penalties calculated from the original April deadline.
And number 4, the trust fund doctrine. Withheld taxes are instantly quarantined as government property. A withholding agent is a fiduciary. Commingling those funds with daily operating cash is a direct violation of the law.
That checklist is your armor for the multiple choice questions. But before we sign off, I want to leave you with a broader perspective to chew on. When the CREATE law was passed, it included a mandate requiring the Department of Finance to review the regulations for creditable withholding taxes at least once every 3 years. If they find the rates are adversely impacting taxpayers, they must direct the BIR to amend them.
That provision perfectly encapsulates everything we've discussed today. Tax law is a constant, delicate balancing act. The government absolutely relies on withholding to secure its revenue up front. But if they set those creditable withholding rates too high, they drain businesses of the daily cash flow needed to pay salaries, buy inventory, and survive.
Yeah, they could choke the economy.
Exactly. So as you continue reviewing these strict deadlines and administrative rules, try to see them not just as formulas to memorize, but as policies that directly dictate how businesses operate, scale, and survive in the Philippine economy.
When you understand the underlying economic reality, the rules finally make sense. Keep pushing through your review, trust the deep conceptual work you are putting in, and you are going to absolutely dominate this CPA board exam. Until next time, keep studying hard, and we'll catch you on the next deep dive.